I think it looks that way. I mean, at least until we have a clear and decisive ceasefire that allows ships to go through the Strait of Hormuz, this seems to be the new norm. And the longer the strait is shut, I think you're absolutely right that oil prices would be higher for longer. I mean, the strait has been shut for longer than a month already, and more than 10 million barrels per day of production in the Gulf has been shut in. All these Gulf producers, some of the biggest in the world, they have no storage left. They can't move their oil, so they had to shut in production. So this is obviously very significant. And at the same time, we still have attacks and some damage to some of the infrastructure, some upstream, some refining, some LNG. So it's not really going to be, even if there is a ceasefire, it's not really going to be immediate that we go back to pre-war levels. I think it would take time to get everything back in order and back to pre-war levels.
We also heard that Saudi Arabia raised the price of its main oil grade to Asia to a record high premium because of the ongoing conflict. Salih, is this the beginning of more price increases that would just kind of steadily go up until we have some visibility?
I think so. And I think this is one of the indicators of the physical market tightness. I mean, when you look at the dated Brent price, it's higher than $140 a barrel. So that's flashing tightness in the market. Another one is, as you highlighted this morning, Saudi Aramco announcing that record premium of $19.5 a barrel for its Arab Light price. And I think it just shows this big gap that we have between the physical market, these numbers that we talk about for the physical market, and where what you were talking about earlier on the show, that Brent forward month, the front month being only $109 a barrel. So there's a massive gap there. And it's either that there is a ceasefire and flows continue and the physical market tightness eases and it moves towards that forward month number, or the strait is shut and then we have these kind of contracts, the paper markets move closer to the physical numbers.
Salih, for somebody, I'm going to speak for everybody who doesn't follow global oil, which is you guys got to build some more pipelines, so you can't depend upon the Strait of Hormuz to get that oil out of that part of the world. What's kind of the thinking within global energy circles about trying to de-risk that Strait of Hormuz?
I mean, I think you're absolutely right. One of the long-term consequences of this war will be that all these producers, all these countries will look for ways to diversify away from Strait of Hormuz. And for some countries, this is possible. I mean, when you look at Saudi Arabia, they already have a bypass pipeline, the East-West pipeline that has a capacity of 7 million barrels per day that takes their oil from the east where it's produced all the way west to the Yanbu export terminal. And they've actually been pretty successful in very rapidly ramping this up to pretty much capacity. And I think they would probably be looking at ways to increase that capacity long term. We have another bypass capacity in the UAE. It's a much smaller one. It's around 1.5 million barrels per day. Spare capacity is even less than the nameplate capacity. But these are two countries that have the option to have these bypass capacities, bypass pipelines. There are other Gulf countries like Kuwait, like Qatar, like Bahrain that don't really have that option to have these pipelines to kind of diversify away from the Strait of Hormuz. But for those who can, I think they will be thinking about that seriously in the long term.
We often talk about how the U.S. is in an enviable position because the U.S. is a net exporter of oil now, and this is good news for U.S. energy companies. What does that perhaps overstate? I mean, where are the challenges for the U.S. Exporters?
I mean, I think some of the US exporters, when it comes to oil, but especially LNG, they are insulated. They don't really have exposure to Strait of Hormuz, so their production or supply is not getting disrupted, and they would be benefiting from higher prices. So in that way, they could be some of the more advantaged companies. But I mean, the US being completely insulated, maybe in the short term, but especially for consumers. I mean, oil markets are global. So if some of the grades in the Middle East are rising, it's only a matter of time unless this gets resolved, that some of the other prices in other regions, like in Europe, like in the US, go much higher as well. And then in that case, some of the producers would benefit, but that's a small chunk of the market. And then a much bigger chunk of consumers would be hurt from higher oil prices. That also would trickle down to higher prices in everything else in life that would cause a lot higher inflation.